Module 9. The consulting industry. Who does the work? The structure of the supply side, the recognized consulting roles, how firms combine to bid, and the economics of an assignment. The tiers. First, large international implementers and engineering groups. Firms with hundreds to thousands of staff, offices across regions, and the balance sheet to carry large multi-year contracts. 4 kinds of organizations sit in this tier. The U.S. development implementers, built around large government contracts. The engineering and infrastructure houses, most of them European, which carry design and supervision work at scale. The Japanese engineering consultancies, which follow their country's concessional lending into large infrastructure. And the European development consultancies, alongside the government advisory arms of the largest accounting firms. This module names no individual firms deliberately. Rankings shift, they depend entirely on which measure is used, and the tier is what matters, not the league table. One warning about this tier: it was severely disrupted by the termination of U.S. assistance contracts in 2025. Several of the largest U.S. implementers contracted sharply or restructured. Verify the current standing of any U.S.-exposed firm before treating it as a stable partner or employer. Second, mid-tier specialists. Dozens to a few hundred staff, dominant in one discipline rather than present everywhere: evaluation, public financial management, health systems, water, climate finance, transport economics. They win by being the obvious choice for a defined scope, rather than by being able to do everything. Third, boutiques. A handful to a dozen people, usually built around named experts and a specific reputation. Fourth, national firms. Domestic consultancies in the countries where projects happen, engineers, economists and social scientists with the language, the institutional knowledge, and the standing relationships that no visiting international has. Some have grown into regional players in their own right. And around the core sit universities and research institutes, which win analytical and evaluation contracts, and NGOs acting as implementers. One segment sits outside firm-level competition, and it is worth recognizing rather than pursuing. A substantial share of assignments, evaluations, focused technical advice, single specialist inputs, positions embedded in a project implementation unit, is sized for one person and contracted directly with an expert rather than with a firm. It matters to a firm for 2 practical reasons. First, it is where a key expert you were counting on may already be committed when you need them. And second, it is a route by which clients form relationships with individuals that later shape firm-level shortlists. The recognized roles. Terms of reference across every funder draw from the same set of disciplines: preparation and design, sector engineer, hydrogeologist, transport economist, energy planner, urban planner, architect, financial analyst, and the economist who does the cost-benefit and economic internal rate of return analysis. Safeguards and sustainability. Environmental and social impact assessment specialist, environmental and social management plan specialist, resettlement and land acquisition specialist, biodiversity specialist, occupational health and safety specialist, stakeholder engagement and grievance mechanism specialist, gender and social inclusion specialist, and indigenous peoples specialist. Climate, mitigation and greenhouse gas accounting, climate risk and vulnerability assessment, adaptation planning, climate finance and proposal development, and the specialists who navigate the accreditation and proposal machinery of the climate funds. Implementation, procurement specialist, financial management specialist, construction supervision engineer, resident engineer, owner's engineer, contract administration and FITIC specialist, and project management specialist. Results, monitoring and evaluation specialist, results framework designer, independent verification agent, impact evaluation specialist, and data and statistics specialist. Institutional, public financial management, tax and revenue administration, regulatory reform, utility restructuring, capacity development, and public-private partnership and transaction advisory. And senior, team leader and deputy team leader, who carry client relationship, quality and delivery responsibility, plus the key expert positions named individually in the contract. Which brings us to the distinction that decides how much a proposal depends on you. Most funders distinguish key experts from everyone else. Key experts are named, they are scored in the technical proposal, and they cannot be substituted without the client's approval. Non-key experts and support staff are none of those things. Being a named key expert on a winning proposal is materially different from being pool staff. How firms combine. Prime and subconsultant. One organization holds the contract and carries full responsibility to the client, others deliver defined parts beneath it. The prime is paid by the client and pays the subs, which means subcontractors are exposed to the prime's cash position and payment behavior. Joint venture, consortium, or association. Two or more firms bid as partners, sharing work, risk, and reward, usually with joint and several liability to the client. It is used to combine an international track record with national presence or engineering strength with social and environmental depth. Association of individuals. Independent experts assembled by a lead firm or by a client into a team, each on their own contract or as subconsultants. Eligibility rules are what make this matter. Minimum turnover, years in operation, comparable assignment references, and nationality restrictions where aid is tied. Combining is often the only route to eligibility for larger contracts. Choosing a partner. This is a commercial decision made under time pressure, and it is where bids are most often lost before they are written. Start from what the partner must supply. A required comparable reference, a nationality eligibility you do not hold, a national registration or professional license, staff you cannot field, or turnover to clear a threshold. A partner who adds none of these adds cost and risk. Then verify. Legal registration and good standing. Tax and Social Security compliance. Audited accounts sufficient to support the turnover claim. And a check against the multilateral bank's published debarment lists, because a debarred partner disqualifies the whole bid. Confirm past performance with a client reference, not a brochure. Then settle terms in writing before the proposal is submitted, not after award. Which entity is prime? The division of work and of contract value, who holds which key experts. Liability, which in a joint venture is normally joint and several, meaning each partner is answerable for the whole contract. How reimbursables and in-country taxes are handled, and how the arrangement ends if you lose or if the scope changes. A teaming or pre-bid agreement covers the bid. Some requests for proposals require a signed joint venture agreement or a letter of intent with the submission itself. The recurring failures are avoidable. A partner who signs with two competing bidders because exclusivity was never agreed. A local partner whose presence turns out to be a letterhead and a rented address. And a memorandum of understanding treated as a binding commitment when it commits nobody to anything. The economics of an assignment. Two categories of money, and confusing them is the most common beginner error. Fees are payment for expertise, a rate multiplied by the number of days or months worked. This is the earnings core. Reimbursables, also called out-of-pocket costs or provisional sums, are project costs that pass through without profit. International and local travel. Accommodation and per diem. Office and vehicle costs. Surveys, laboratory testing. Workshops, translation, and printing. A large headline contract value can be mostly reimbursables. Always separate the two before judging an opportunity. For a firm, a billing rate is built from base remuneration, plus a loading for overhead, offices, finance and contract staff, insurance, certifications, and the business development cost of proposals that mostly lose, plus a margin. The multiplier applied to base remuneration varies widely by firm and by country. It is negotiated with the client on time-based contracts, and several funders require it to be justified with audited evidence. Utilization is the share of available staff days that are actually billable. It is the variable that determines whether a firm is profitable, and it is depressed by proposal writing, by mobilization gaps between contracts, and by slow client decisions. Then contract types. Lump sum, a fixed price for defined deliverables, with the delivery risk on the consultant, used where outputs are well specified. Time-based, payment for time actually spent at agreed rates, plus reimbursables, used where the scope cannot be fixed in advance. Read which one you are bidding because it decides who absorbs an overrun. And cash timing. Payment follows deliverable acceptance and the disbursement chain from Module 8, not calendar convenience. Withholding tax, VAT, treatment and permanent establishment rules in the country of assignment materially affect net income, and they are frequently overlooked at bid stage. Backstopping and what the firm carries. A fielded team is not the whole delivery. Behind it sits home office backstopping, contract management, quality assurance, and peer review of deliverables before they reach the client, technical direction, safeguards and compliance oversight, logistics and travel, and financial reporting in the funder's format. Some funders allow backstopping as a budgeted line in the financial proposal, whether as named home office professional staff or as a defined percentage. Others expect it to sit inside overhead. Read the financial proposal format before assuming it is recoverable, because unbudgeted backstopping comes straight out of margin. The firm also carries commitments an individual never sees. An advance payment guarantee, issued by a bank, is normally required before a mobilization advance is released. Performance security is required on some contracts. Professional indemnity and third-party liability insurance are contractual obligations with stated minimum cover. These consume the firm's banking facility and insurance capacity, which is a real limit on how many contracts it can hold at once, a constraint that decides bid strategy as much as technical capability does. Key expert substitution is a live commercial risk. Named experts cannot be replaced without client approval, and a substitution the client considers unjustified or of lower quality can trigger a rescored evaluation, rejection of the replacement, or a contractual dispute. That is why written availability commitments at bid stage matter, and why proposing an expert you cannot hold is an expensive way to win. And time-based contracts require auditable timesheets. Funders retain audit rights over rates, records, and reimbursables for years after completion. Record keeping is a contractual obligation, not administration. Localization. Funders and providers have committed to shifting a larger share of contracting to national and local organizations, and procurement is increasingly structured to require or reward national participation. The direction is clear in policy. The pace varies by institution and by country. For internationals, it raises the value of genuine national partnership over nominal local content. For national firms, it is the strongest structural tailwind in the industry. Before you rely on any of this, check the source. This module describes the shape of the supply side, not the standing of any particular firm, ownership, size, and capacity change through acquisition, restructuring, and funding shocks. Rate multipliers, tax treatment, and contract templates are set by the funder and the country, not by convention. In summary, the supply side runs from large international implementers and engineering groups, through mid-tier specialists and boutiques, to national firms, with research institutes and NGOs alongside. Work is defined by a recognized set of disciplines, with named key experts carrying the scoring weight. Firms combine as prime and sub, or as joint ventures, to meet eligibility, and partners must be verified and tied down in writing before submission, not after award. Assignment economics turn on separating fees from reimbursables, on the overhead multiplier on utilization, and on whether the contract is lump sum or time-based. And beyond the fielded team, the firm carries backstopping, guarantees, insurance, and audit obligations, its banking and insurance capacity limiting how much work it can hold at once. Next, finding the work, pipelines, portals, and opportunity identification.